Hello and welcome to the i3 podcast Conversations with Institutional Investors. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3, that's the number 3, invest.com. There you can also subscribe to our complimentary newsletter, i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. Welcome to the i3 podcast. I'm here today with Eduard van Gelderen, who is the head of research at FCLT Global. He took on this role at the end of 2024 after spending 6 years as Chief Investment Officer of Canadian pension fund PSP Investments. But he's also well known for his past role as Chief Executive Officer of APG Asset Management, the investment arm of the €500 billion Dutch pension fund ABP. FCLT stands for Focusing Capital on the Long Term. It's an initiative that was born out by the efforts of consultancy firm McKenzie and Mark Wiseman, who was then the CEO of Canada Pension Plan Investment Board, CPPIB. Together, they wanted to change the investment industry after the global financial crisis, or the Great Recession as they say in the US, away from a so-called quarterly capitalism that contributed to the financial meltdown, and place more emphasis on long-termism and the role of investors as stewards of capital. Eduard, welcome to the show.
Thank you, Wouter.
So we're here in our office in Australia. What brings you to Australia? Because you were based in Canada, now I think the US.
Yeah, I'm still in Canada, so I remain living in Montreal. But FCLT Global is a Boston-based organization. A lot of people actually are not based in Boston like me, but we do come together every week, or not every week, but a week once every month, when the whole team, roughly 20 people, are actually in Boston. So we're Boston-based, but I'm still living in Montreal.
Fair enough. So how did you get involved with FCLT Global?
So your introduction is spot on. Next year, we will celebrate our 10-year anniversary. But the genesis is indeed by a paper written by Dominic Barton, which was at the time the managing partner at McKenzie, with the title Capitalism for the Long Term. And you're absolutely right, Mark Wiseman jumped in. And they together in 2013 created basically FCLT. But it was only after some corporates and investment managers joined, like Dow Chemical, Tata, BlackRock, when FCLT was formally established as a research institute in 2016. So next year, again, like I said, is the 10-year anniversary. The main product, the main service that we have for our members, because it's a member-based research institute, is basically the research itself, linked to the mission, and different tools that we create for our members. I've known the institute actually quite well because, as you said, when I was the CEO of APG Asset Management, we actually became one of the first members of the organization. So I've known the organization for quite some time. And when I left PSP over the summer last year, I reached out to the CEO of FCLT, actually asking advice, like what would you do if you were in my shoes? And while we were talking, basically the idea of joining FCLT became more and more a reality because it fitted so well with what I was looking for. So what is important to me are basically three things: change and innovation, strategic thinking, and having an impact. And I really believe that, FCLT is a platform where this all comes together. And so I was very happy to join the organization only a few months ago.
And I think the head of research also nicely aligns with sort of your academic activities that you've done during your career. We've spoken in the past a little bit about the Canadian model.
Yeah.
We touched on factors and the role in portfolios. So is that sort of what you were thinking of?
Yeah, it is definitely a very important reason for me to join FCLT. I never stopped writing the papers. I will never be a full-time scholar. I think the papers that I've written in the past are all very empirical and practical, and that fits so well with what FCLT is doing as well. So that link was very important, but the other thing very important to me was the platform, the members. So we have 65 members covering corporates, asset managers, and asset owners. So basically covering the whole value chain. And these 65 members are very impressive. And to come back to your first question, what brings you to Australia? We also have some members in Australia. Yeah. So I'm actually here to meet up with them, to introduce myself. And we actually have a joint event with one of the members in Melbourne later this week.
Yeah, so I think the Future Fund is a member, AIA is a member.
Exactly.
There's a couple of funds
IFM,
here. Yeah, IFM, of course. So if we delve a little bit into the idea behind long-term investing and sort of the philosophy behind it. So I came across a statement that sort of tied together the role of investors as stewards of capital and long-term investing. And it actually came from the British economist John Kay, who said that there is actually a premium that can be derived from being a steward of assets. Is that the philosophy that you share?
Yeah, and John Kay was certainly not the only one. Like I said, Dominic Barton, his article dated, back to 2011, is basically the same story. But even if you go to Keith Ambachtsheer, the pension expert, the Dutch pension expert in Canada,
from Rotterdam,
exactly, he will tell you that basically Peter Drucker is the basis of the Canadian model. But when you read his book, Pension Fund Revolution, it's the same message yet again. And they all point in the same direction, like issuers and investors should be aligned and really should focus on the long run. And in a way, it's pretty straightforward what the reasoning is. Like if corporates are too short-term focused, they will not invest enough. So they will underinvest in really value-generating projects. And then the question is like, not only do they not create any value long-term, but what do they do with all the capital left on the table? And what we see is sometimes they decide to buy, basically do buybacks, and we believe that is not the way to go. If you don't have any purpose with the money, give it back to the investor, and they can then reallocate it to. But the general thinking is like the corporates should, in the real economy, really create value by investing long term. That should be their role. And when you go to the other side of the table, the investors, if the investors are too short-term focused and really constantly look for quarterly results, basically what they do is they trade on noise. And that creates a lot of turnover, but it certainly doesn't create a lot of value. So also the investor should actually look for signals instead of the noise. Signals coming from the corporates, like how do they think about the future? Where is the true value creation going forwards? So you're absolutely spot on. This is the general thinking behind what we do. We do believe that if investors and issuers are really focusing on the long term, that the economy will benefit from it. And this is, in the end, what I think everyone is looking for.
So I think FCLT had a symposium earlier this year in New York, in February, I believe.
Yeah.
And it produced a paper on the back of that sort of gave a highlight of some of the discussions. And I thought it was interesting that part of the emphasis on long-term investing included an idea that you basically want to get closer to the companies and be more responsible owners, but also build better relationships with them. And as I was reading it, I thought it sounded a little bit like a private equity model, a little bit like the Canadian model.
Yeah.
But is there truth in that? Is it easier to do long-term investing in private markets?
Let me first react to the private equity model. I do like the private equity model, so don't take me that I don't like it. I do like the private equity model. I think there's true value in what they do. When GPs are looking for business opportunities, find business models where they see inefficiencies, whether it's on business development or it's operationally, they go in, they step in and improve it. The direct, not engagement, but the direct involvement that they have with the companies is actually very good and leads to results. But there's one big difference. In the end of the day, the private equity GPs are looking to monetize their investments as well. And on average, that's on a horizon of 5 years. So there are two questions here, like, well, is 5 years, is that really long term, or is it still very short term? The other question is like, well, if I am an asset owner and I'm very happy with a company that continues to generate the returns that I'm looking for, I don't have any need to monetize. So I would be careful in linking the idea of long-term investments with a PE model, because yes, there are definitely overlaps, but there are also very distinct characteristics in the private equity model that do not necessarily match with how we think. But it's absolutely true that we feel like an engagement between basically the triangle of management or CEO, board, and investor is very important to generate returns. And a lot of research that we do is based on the governance around these three elements. So yes, we think there is clearly a lot to win. If a board is aligned with the CEO, if a board is aligned with the larger shareholders, and the CEO is aligned with the shareholders, if we can make that work, I think there is a great opportunity for value creation.
I think the paper you referenced earlier from McKenzie also talks about the role of the board, and that boards of investment companies should actually be very skillful and very knowledgeable in order to take on the role of an ownership role in the companies they invest in. Do you think that is achievable for, average pension funds, where people might have a very experienced background but not necessarily are into the financial detail?
So that's a nice question, Wouter. One of the things that I really enjoyed when I moved from the Netherlands to Canada was actually to see the difference in the board composition. So there is no criticism here, but if you have a board that really has no practical experience in running businesses or running investment organizations, but, for example, are union leaders, clearly they have a lot to say and they have a lot to contribute, but they do not understand the nitty-gritty of indeed investments. When I moved to Canada and I saw the board at PSP, which are all professional board members, they all had relevant experience, whether it was part of an insurance company or it was part of an investment company or in another corporate. But they were very hands-on and advised us in many different ways. And we presented several investment cases to them. And based on their experience, they actually gave us feedback and helped us in the decision-making. So one of the key elements of the Canadian model is, having a professional board in place. And I do believe that is very important.
Yeah. I can remember I spoke many years ago with Claude Lamoureux, who was the first CEO of Ontario Teachers to bring basically the change in. And he emphasized that you don't have to be an investment specialist, but you definitely have to have, a solid grounding in finance and in the markets to be able to do that role, which was very interesting because here in Australia we still have, the argument around independent board members. We still have representatives of industries, which often have a very different background than from the finance world. But at the same time, there's this discussion about sort of, diversity of thinking, which might come from these angles.
Yeah, I think, I'm speaking about the experience I had at PSP, but I'm sure other pension plans have a similar approach. When you think about the board composition, they tend to work with a matrix, like what are the different competencies that we need to have, and which board member is actually representing this. And that is, actually a very broad set of factors. Like it can be like purely finance, but it could also be in HR. It could be someone in merger and acquisitions. It's so really risk management and compliance. So they are very serious about how to compose the board and who is playing what role. And I think that is actually very good, a very good thing to have.
This emphasis on ownership of companies, to a degree, you could sort of say that the more you own of a company, the bigger the stake, the more influence you have. And related to that idea is that the opposite is probably also true, is that increasingly smaller stakes, you have less to say. And I remember I did an interview a while ago with Jaap van Dam, the former chief strategist of PGGM. And he made a comment that, being very well diversified is not the same as being very close to a global benchmark. And that sort of correlated with this idea that passive investing also seems to fragment ownership. And so you have less influence. Is that good for the market? And is that actually, you think you're diversified because you own a lot of different companies, but at the same time you reduce your influence. How do you see that interplay between, stewardship, long-term investing, and passive investing?
Yeah, I think Jaap is spot on. But then again, he has been around, for a long time, and he has seen many different investment strategies. I can only agree with him. I think what happened, basically in the market in general, is that, we've been so focused on this whole concept of market efficiency that we actually moved away from true investments. So it almost becomes like a procedural approach, like, hey, the market benchmark is the best, is the optimal portfolio you can have. The wisdom or collective wisdom of markets is very hard to beat. And in a way, all these concepts are true, but it also has two big problems. One is, I think it pushes us to short-term observations. And the other thing, everything is put in a relative perspective. And when you think about stewardship or long-term ownership or whatever label you want to give it, I think what is key to this is that you really truly understand the business models you invest in. And it's impossible to have 4,000 name in your portfolio and then still pretend that you know those 4,000 business models in and out. But it's not needed either. And I think that is exactly what Jaap is trying to say here, is like, you don't need to mirror basically a benchmark to come to diversification. If you really truly understand business models, your portfolio can be way more concentrated and still have that concentration of that diversification in the portfolio. And the other thing is what I mentioned is the relative perspective. I think we really need to move back to a more absolute return perspective. It's almost like, that we now accept, like, we don't know where markets are going to, so we don't care about the market returns anymore. We only care about the alpha returns. Well, I don't think that is the right way to do it. You should be concerned about absolute returns. In the end of the day, that is your investment mandate. Also for a pension plan, you have to generate the returns that are needed to keep the fund solvent. So absolute returns are important. And the question then becomes is like, how are companies actually generating their returns? You can only do that by fully understanding their business model. And again, it helps if you really sit down with the board and or the CEO and talk about their plans. What is it that they see? What is it that they see? Where they see the opportunities? Where do they need to invest? And the investor should give them basically the trust to really, adopt that long-term view, and not run from quarterly earnings to quarterly earnings. And now, hey, you don't meet the expectations. Now we throw you out of the portfolio. And the next quarter, actually, you're beating expectations, and now we buy you back. That is not the basis for value creation. So I think Jaap is spot on. I think his story is like diversification is very well possible with a not a small number, but definitely with a more limited number of names than the index can give you, and maybe even better, to be honest.
Yeah.
But I'm challenging Jaap here to say that.
We'll call him up. So I think long-term investing also creates the ability to think more long-term and then play into some of the big trends that faces both the economy and society. And I think at the moment, one of the big themes out there is the energy transition.
Yeah.
So actually, when I sort of was looking up the numbers, I didn't realize that FCLT was partly started by McKenzie, but I'm quoting a McKenzie number here, no bias. But they basically said the energy transition will require about $9.2 trillion US dollars in annual average spending on physical assets alone. That's a lot of money. So it sounds like a great opportunity from an investment perspective. But of course, it's addressing something that is a potential risk. How do you look at it from a long-term investment perspective? Is this something that companies should play into? Is it the biggest opportunity, or do you see it more as a risk?
So just the numbers alone tell you that basically the green transition is a long-term theme. It's impossible to waste that money, on the short term. So it is almost by definition a long-term investment theme. And we wrote a report with the title Great to Green, where we also mentioned that according to us that there are investment opportunities. So it's something that we probably have to do. If you think outside of the investment world, the green transition is really needed to basically to hedge the climate change. But it does come with opportunities too. Now, I do think that there are a couple of points to make here. First of all, when you think about the economy and you divide it up into different sectors, there are clearly a few sectors that are very intensive, of carbon intensive, like energy, transportation, steel, cement. So I think those sectors really need to pay a lot of attention to what can we do in light of the green transition. And I'm emphasizing like they should really think about it, because if they don't, I'm sure they will be forced, whether it's by regulators, whether it's by governments or whatever, there will be a lot of pressure on those sectors to do something. And if they don't, they will be punished. For an investor, that means there is a financial reality here. If you invest in a company that is not willing to change anything and they will be punished, this will lead to losses. So for an investor, that's a very, clear financial reality. It has nothing to do really with like, oh, I'm trying to do good and it's best for society. No, there's a financial reality attached to it. But at the same time, if you go outside of those, let's say, 4 sectors, there are many sectors who are not carbon intensive. And interesting thing is when we speak to our members, we oftentimes hear stories that on the corporate side, actually the carbon price is actually at this point in time is actually not very relevant for their decision making. It's too low. It doesn't impact their decisions, especially the ones that are not carbon intensive. So I think as an investor, again, you have to be very careful, like where are the opportunities? What sector is really forced to change? But you also need to understand like how can they actually change? So you need to have a view on this whole green transition, how it's going to take place, what kind of technologies are needed, etc. And that's not trivial. That's actually pretty complex. So one of the things that certainly happens when you are an investor is like, yes, there might be opportunities, but there are also a lot of uncertainties around it. And if I take, the wrong bet, if I think a certain technology is going to be the winning technology, but it doesn't, I'm making the wrong bet. So as an investor, what you have to do is think very carefully, not only about that point, but also like if I diversify over different sectors, I need to use the less intensive sectors also to hedge basically what I do in the carbon intensive sectors. So that's a portfolio construction question. So, when people claim that they know how everything is going to take place, how the green transition, and they start to use, comments and labels like, oh, it's scientifically proven, I always get a little bit itchy because, I think the whole journey we're going through is still at the very beginning. There's still a lot of unknowns, but I do believe that for investors, long-term investors, this is an area they really should focus on.
I was interesting to see in the symposium paper, it was talking about this topic, and it mentioned, of course, stranded assets, which we have been talking about for some time. But then it went one step further, and it talked about stranded business models.
Yeah.
Do you think we're getting to that stage yet?
Yeah, I do believe that there will be, the winners, but there will be losers too. But that's a natural thing, right? If you go back in history, the ones who adjusted to all the opportunities that the internet actually offered became the winners. But there are certainly companies that completely missed the boat. I'm convinced we're going through a same cycle again. Companies really need to be very careful in what to invest in, how to allocate their capital. And some will make very good choices. Others might actually do not. Yeah. And it's the role for the investor to basically make sure they have the one and not the other. But like I said, that's not a trivial task.
No. You mentioned that the carbon price and the fact that I think investors seem to agree that climate risk is underpriced. Yeah. Isn't the market always right? What happened there? Is that an opportunity for a long-term investor?
That's a nice comment. In principle, I will say, yes, the collective knowledge of markets is always right. But it doesn't mean that everyone is thinking the same way. So, even around a market price, there's a large distribution with outliers to both sides. I think, if you think about carbon pricing, I don't think there is a efficient market at all at this point in time. So we can very easily say carbon price is on the price. It should be way higher. And I tend to agree with that, to be honest. But if you really then ask the question so where is the current price coming from then? Well, it's artificially set. Some people point at the insurance markets, but then again, we have to be aware that insurance contracts are only 1-year contracts. Insurance doesn't cover all the climate risk that we have to deal with, so it's only a subset. So also the insurance market doesn't really give us a full picture. And if you think about, the market for carbon credits, similar story. It's not an efficient market at this point. I think it will probably move that way, and especially the market for carbon credits. I'm hopeful that will be a good indicator of what the true, between brackets, price of carbon should be.
Another long-term trend is the rise of artificial intelligence. It is still relatively new, but it's starting to have serious impacts on businesses.
Yeah.
How should long-term investors tackle this? Is this a matter of risks in terms of business models becoming obsolete, technological disruption? Is it purely an opportunity? Is it just a new toy? And I believe you also have a personal interest in this from an academic point of view.
Yes, so I can tell you from that point of view, I do not believe at all that it's just a toy or just a hype. I really believe that AI is going to disrupt a lot of things that we currently take for granted. I think it will turn a lot of things upside down. But the interesting thing, the question you ask is very interesting. How should long-term investors look at this? And I think we have to kind of pull things apart. So one is a long-term investor, and what we spoke about earlier, they should know what the business models are they invest in. AI is going to disrupt a lot of business models. So one of the first things long-term investors should actually pay a lot of attention to is like is AI technology going to impact business models? So you need to have the expertise, at least when you do things in-house. But if I talk about Canadians, they do actually manage the portfolios in-house. They need to have the expertise to understand how AI technology will change business models. And again, AI is not a one-trick pony. That there are very different ways, applications, technologies, etc. But that's very important because, again, it comes back to the question similar to the green transition. Like, there will be winners and losers. There will be certainly companies who will completely miss the boat. And I think it will go very quickly. So one part is understanding the business models that you invest in and how AI is going to impact or disrupt those business models. But then you can think about, the investment organization itself. That's a business model itself, right? So how is AI going to impact, basically the business model of the investment manager? And I think there are two ways to look at this. One is it will certainly bring operational efficiency. So all the focus now we have on LLMs in terms of, reporting, analyzing a lot of documents that we have available. In all fairness, I think a big part of that is just operational efficiency. Not unimportant, because let me give you an example. If you are a private debt investor, and every issue comes with a lot of documentation, to have an analyst to go through this documentation over and over again is very labor intensive. And there's nothing new what I'm saying here, but if you start to use AI and every document that comes in, you just, apply the AI tools and say like, oh, wait, give me the key messages in the documents and to what extent does it actually differ from what we already know. That is a huge operational efficiency. So that's that part. And I think a lot of investors are already trying to put that in place. I think the biggest challenge, and where a lot of investors, specifically asset owners, are not very advanced, is like, how can we use AI as advanced analytics? How can we do our investment strategies differently with the help of AI? And interestingly enough, here you can it's not just about alpha generation. Like, AI is not just about like, first I had a quant team doing alpha management, and this is the next level. It's just AI on top of the quant, and I still focus on AI. No, AI can actually be applied in portfolio construction. It can apply to risk management. It can apply to trading, a lot of different things. And what I think is important for the investor is to think very carefully, like, where do we get the most benefit from AI? What part of the whole investment cycle does it really gives us the best, benefit for the amount of money that we have to spend in it? And a lot of my observation is that a lot of, especially asset owners, are not actually dealing with that question yet.
Yeah.
So there's still a lot of also open questions out there that, like, is AI really going to make a difference if we take an investment horizon of 5 years? We don't know yet. So there's a promise, like, well, probably yes, but we haven't seen the evidence yet. But an interesting thing is when you think about the current environment, which is pretty uncertain, right? With economic uncertainty, geopolitical risk on the rise, so the world is in a state of uncertainty, and everyone is now thinking like, do I have the right portfolio in place? Is this the portfolio that is still resilient, and capable of dealing with all these uncertainties? And the interesting thing is, like, well, we can fall back on the traditional techniques, but that is not going to give you the answers. The historical data that we have are not going to answer that question, but AI potentially will. So even, dealing with the current environment and seeing what AI can do for you, I would argue, like, it's worthwhile just trying. Even if it's not perfect, it's worthwhile trying.
And I thought it was interesting In this paper from the summit, it addressed geopolitics as a long-term trend, but it tied it back to diversification, and it made a comment that actually in this period of so much volatility, global diversification can increase risk rather than decrease it. Do you think we need to rethink diversification in this environment?
Yeah, I do, and it links back to my previous comment. I really believe that we're coming out of a long period where interest rates were going down. We had globalization. Everything seems to work, and everything seemed to actually help investors. Now we're at almost like a tipping point. Like, gosh, everything seems to break down. And again, I when you think about it, how can we diversify in this world? And I do believe that if you really start to decouple, which starts to happen now with all the tariffs and actions taken by different governments, it's almost like we're back on our own. So all the countries are now dealing with their own problems. And therefore, you need to go, and Trump actually said this, we're going through this transition in the local economies again. And that is probably most volatile. But the question is, how will that impact the portfolio? Because yes, the individual countries might be more volatile, but if we really have a decoupling, then actually the correlation between the countries might actually go down again. And then it helps actually to continue to invest globally. So I'm not sure, to be honest, where this is going to, but I do believe that you have to think very carefully that the traditional way of thinking over the last 20 years, that diversification is a free lunch, everything is fine as long as you spread your portfolio, I think you really have to reassess that.
Yeah. And that comes again back to sort of the benchmarks that if you just take a blanket approach, you might load up on risk.
Yeah, and the other thing is, to be honest, geopolitical risks are not stable.
Yep.
So one of the problems I find now is that if you open up the media, if you read about articles, it's one after the other saying how bad everything is, and the recession is even worse than we thought yesterday, and everyone is actually saying the same thing in the same direction. But it's also very short-term focused. Because the other thing you could argue, maybe there is a silver lining in terms of, it forces governments to really think about their economic development policies. Take Canada. In all fairness, Canada is very dependent on old economies. Maybe this is the trigger to really be serious about starting to support a new economy, new sectors. And so longer term, this might actually be a very good thing. So yes, everyone is very worried about the short term now, and rightfully so. But I think there is a silver lining. Longer term, this might actually be not a bad thing at all.
Might turn out to be a catalyst for the next phase. So maybe we finish up with looking back at sort of your role at FCLT, head of research. What is on your research agenda?
So there are several topics that we spend a lot of time on. One is and we touched on this earlier, is future fit boards. So like I said, we do a lot of research with our members, by the way. We use our members to think with us about these topics. But how can you better align the boards with the CEO and the strategic shareholders? So we call it future fit boards, but it's broader than that. And I think the paper will come out very, very shortly, how we can establish that. We have a project on proxy voting. Proxy voting seems to be the one item everyone agrees on. It doesn't, make me very happy. Corporates are not happy with the current system. Investors are not happy with the current system. So one of the things we were looking into is how can we change the system that at least both sides of the value chain are happy. So that's another work that we focus on. Whenever we speak to members, the one question that always comes up is the divide between public and private markets. That's a very broad topic, to be honest. a specific element to this is like, what is the role of retail investors? If now GPs are trying to develop products for retail that give them access to the private markets, how is that going to change the dynamics in private markets? But that is just one. I firmly believe that with the whole digitization and AI, I think public and private markets actually will move closer and closer together. And a little bit the artificial divide, that there are two separate markets, I think will disappear. And some investors are already working in that mindset or using that mindset when they think about the total portfolio approach. Like where are the best investment opportunities, irrespective whether it's in the public or the private. So there are a lot of questions related to that topic. AI is something we will spend time on, and we will continue to improve. Basically one of our main or flagship products, which is called the Gold Standard, which are basically tools for our members to really stick to a long-term perspective. And basically that it's based on all the research that we have done over the last 10 years and external research. The product itself is rather simplistic because it basically has a set of 10 questions for corporates, asset managers, and asset owners, basically asking them questions, yes and no questions, which gives an indication to what extent they're really truly long-term. And that's a product that we will continue to improve and make better.
Yeah, that part on public and private markets probably coming closer together. Is that a factor of information and information advantage becoming more difficult in a world where there's so much information floating around, and you can use AI probably to distill that in more practical, smaller amounts to digest? Is that information edge eroding? Is that why they come together?
I personally believe that is the case. You can even say with the whole digitization, on the public side, there's way too much information. And actually, we have to find ways to filter out what is the relevant information here. And AI can actually help us. But, we need to focus on the true data that is helpful for decision making. If you then move to the private side, the story was always like, well, it's a pretty opaque market. There's no transparency. There's no data, especially on the transaction level. That is disappearing very, very quickly. That data, that information is growing every day. And a lot of participants in that market are actually very creative and successful also in creating proxies. Even if you don't have the specific data on one particular transaction, there is always a proxy that mirrors basically that one transaction. So on the one hand, we have too much information in publics and we need to bring it down to what is really relevant. Mm-hmm. On the private side, there was not enough data, and that is moving up very quickly. And I truly believe that the two will merge at a certain point. So it's really a data thing here.
Yeah. Sounds like there's plenty of interesting areas still to research in markets. Yeah. Well, Eduard, thank you very much for this conversation and for coming to our offices. It's much appreciated.
Thanks, Wouter. It was a pleasure to be here. Thank you.
Thank you all. Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3-invest.com. And don't forget to like, subscribe and review. Thank you very much.